and welcome everybody to the show. Welcome to Ian Francis, who's going to be joining us in a moment to talk about his fund, CQS New City High Yield. It's been a sort of relatively quiet week in investment trust land, obviously until the Russian assault on Ukraine yesterday, which has injected some sort of volatility and some uncertainty into markets. And we're sort of seeing that filter out really across the board. Despite those, there's a few things that I picked out that I just wanted to quickly draw to your attention before we get on to speaking with Ian. The first is sort of digital nine infrastructure. I also want to talk about Crystal Amber and Allied Mines. We've had some results from Bluefield Solar this week that I think may have been overshadowed, and there's some strong inflation linkage coming through there that I also wanted to talk about as well. We've also had an interesting announcement from Jeffy, and yesterday I think this probably very much got overshadowed by what else was going on. GCP Co-Living REIT has announced that it's paused its IPO, but also just want to talk about what's going on with sort of markets with Russia, etc. as well. So we talk about digital nine infrastructure first. So back in January, this announced that it had basically sort of signed a purchase and sale agreement to acquire 76% of Tetra Island Communications Limited. It was already an investor in this, but it had sort of an option to acquire a majority stake. And basically this provides a sort of large wireless network sort of within Ireland. And it was really their first investment into sort of one of its four key target subsectors, which was wireless digital infrastructure. One of the key things about this was it would have actually deployed all of Digital Nine's IPO proceeds, but it appears that that's now not going to happen, because it turns out that sort of somebody else also was higher up the food chain and had a preemptive right. And this was mentioned at the time, but literally with Digital Nine getting their agreement in place, this has brought the other minority shareholder out of the woodwork, and they have decided to exercise their right to take majority holding. This means that sort of Digital Nine's purchase agreement is now cancelled. I sort of find this a little bit surprising that they've sort of gone to the lengths of actually getting this in place. I mean, this would have cost money, this would have cost sort of time in lawyers' fees, etc., etc. And clearly it's not gone ahead. I mean, whether they wanted to force the other party's hand or not, I don't know, because you can't necessarily see what's going on in the background. All of that said, it doesn't look like it's going to be too much of a problem, because they've got a large near-term pipeline, about £450 million, and about 1.8 billion. So there's a typo there I can see on my slide, in the sort of medium term. So that shouldn't be an issue. If we look next at sort of Crystal Amber and Allied Mines, just to sort of give a little recap here. So Crystal Amber, basically it failed its continuation vote last year and basically agreed to return cash. As they said at the time, it was never designed to be an evergreen fund. This particular vote actually required a 75% majority. So it was really designed to make sure that shareholders absolutely wanted the fund to continue at the time. At that point, there were a number of sort of key strategic holdings, and I don't know if you can sort of see the slide there, there's a number of them listed out. They're making progress with all of these, and they sort of expect to have all the proceeds back really by the end of December 2023, which really was sort of 2 years, a sort of 2-year horizon. But there appears to be one particular holding which is not, or just shy of 20%, so that's Allied Mines at 18.2. And clearly they're having some issues with this, and this has sort of come to head, and they're now taking some sort of proper positive action on it. So basically, sort of latest thing they're doing is they're actually calling for the chairman, Harry Rain, to resign. Some months back, Allied Mines put in sort of place a strategy whereby to sort of improve returns, that the sort of board effectively took direct control. But sort of Harry Rain really here is the key decision maker. But since this process has sort of come into being, a lot of it's come out of the woodwork, and Crystal Amber now think that Harry Rain is a major impediment to sort of value protection and realisation. They've listed out a sort of bunch of issues or concerns they've raised. They don't think they've got a resolution to, or sort of see any sign of a resolution to. We've done a news post on those, so I won't repeat those here, but if you're interested, go and have a look. But they're now basically looking to get Harry out so they can move on with the process. I think the sort of key thing that I would draw to your attention here, particularly if you're an investor, is depending on how this goes, this could either accelerate or sort of decelerate the realization process. So obviously there's a bit of uncertainty there. It's just something to be aware of. Next thing is Bluefield Solar Income Fund. I attended the results meeting for this early this week, sort of first physical meeting that they've done since the beginning of the pandemic, which was sort of quite interesting, finally sort of see some people, although judging by a lot of people clearly are not coming back to the office. These I actually think were a decent set of interims. So NAV per share growth of 62.2%. This is sort of driven by rising inflation and near-term high power prices, which is not really a major surprise. And we're all feeling that really in our electrical bills. And with these guys, as fixed or largely fixed cost operators, if they can just sell the power for more money, it largely drops through to the bottom line. The nice thing is that they've been able to raise the dividend target. That's now up to 8.16 pence per share. It was at the beginning of the year 8.12 pence. So you're now going to get a sort of 6.75% yield on that. I think a couple of things that I'd really like people to take away from this is that just the extent to which you've got decent inflation linkage in these results. So 63% of Bluefield's revenues are regulated and explicitly RPI linked, and they've got an average duration of 13 years. So this runs a long way out. So if we find that we've got persistent inflation, you're going to see the sort of NAV go up, and you're going to see the revenues come up, and you're going to get that linkage coming through. The other thing is that actually the way that its debt is structured, it is sort of fixed interest rate amortizing. So in essence, if inflation goes up, it's going to see more coming in the top line, but in terms of its interest costs, that's going to be pretty static. Obviously there'll be some inflation in its operating costs, but actually it's been driving those down as well. So this should really benefit from an environment that's got sort of moderate inflation in. And I don't know that the market sort of properly appreciates that yet. The other thing that came out, and this wasn't explicitly mentioned in their presentations, but was discussed in the sort of room, is that the way the sort of power price forecasters have got their numbers at the moment, we've got high near-term power prices over the next year or so. Then obviously as new supply comes online, there is a big drop-off, and Bluefield sort of seemed to think that actually it's not going to drop off as sharply as the forecasters are suggesting. And if they're correct, this probably applies to pretty much all of the sort of renewables operators in the space. So there could be sort of more to come through there. So just something else to bear in mind. Next fund I want to talk about was Jupiter Emerging and Frontier Income. This is a sort of client of ours. We published a note in January. It's been doing pretty well recently. One of the things that really it is hampered by is its size. I think it's about sort of £70 million worth, and really it needs and deserves to be bigger. But our discount has sort of opened up, and this is something that managers have been working hard to address. As sort of part of this, they put out proposals at the beginning of February to introduce a regular continuation vote and to amend the redemption facility terms. Because to be honest, given its size, sort of shrinking it wasn't really helping us, potentially sort of exacerbating the discount issue. Anyway, they announced yesterday that actually there's now been further shareholder consultation. While originally it looked like those proposals were going to be accepted, that no longer looks to be a case. So there is an EGM set for the 10th of March, and this is going to be opened and then adjourned indefinitely. But they are going to get an update out to the market in advance of the AGM on the 28th of March. Don't know what's going to happen there. We're sort of waiting to speak to the managers. Hopefully we'll have an update for you on that early next week. But just to bear in mind, it's sort of trading around a 12% discount, so that could be interesting. Next one I want to talk about is GCP Co-Living REIT and its announcement that it is pausing its IPO. So back at the beginning of February, GCP Co-Living REIT issued an ITF. It looked like it could be the sort of first new launch of 2022. They were targeting £300 million. The key reason to establish this was it was going to buy 3 assets from an entity called the Co-Living Group, which GCP Asset-Backed Income, Gabby, had made a loan to. Now, the Co-Living Group fell into administration in 2021. Basically, its occupancy levels got really heavily hit during the pandemic. And this created a problem for Gabi because, of course, it had provided this loan. What Gabi did in tandem with some other lenders was to sort of form a syndicate to buy basically 6 of the assets out of the group, or to effectively take control of them. Since that time, they've sold 2 of them. There's a third in the US, which is in the process of being sold. And that actually left 3 assets, apparently all good assets, were located in London. 2 which were already operational, and 1 of them, which is a sort of development site. The idea was that if this was launched, GCP Co-Living would actually purchase all of these assets for about £425 million. Prospectus came out on the 10th of February, but as of yesterday, I say this was paused. Basically, they were sort of citing difficulties in Eastern Europe, creating market uncertainty, and sort of not the time really to proceed with the IPO. All of that said, Gabi says the assets continue to perform well, remain highly marketable, and no NAV adjustment is required. But I think that is just one to watch. If we move on, obviously, the next thing I wanted to talk about before I get Ian on is sort of what exposure to Russia there is in the sector, because a lot of people have been asking us this question over the last 24 hours, and whether there's sort of any kind of opportunities here. So I really want to sort of touch on those points. So if you look at the sort of sector, there is one fund, JP Morgan Russian, with a portfolio that's focused almost entirely on Russia. There's pretty much sort of nothing else in there. And interestingly, in a sort of market where unfortunately sanctions have effectively protected domestic producers, it has, until obviously yesterday, done quite well. Certainly its NAV growth has. You've also got Raven Property, formerly Raven Russia, which sort of owns warehouses and offices, and they're all located in Russia. That's got some obviously significant exposure. Bearing Emerging Opportunities, BMO. This used to be a sort of Russian-focused fund, but actually it changed its name and mandate, and it now just has over a quarter of its portfolio in Russia. And then there are some bits and bobs. There's another 10 global emerging markets investment companies that can invest in Russia, but by and large they don't. And you'll also find the odd fund that holds stocks like some big stocks like Gazprom, Sberbank, Norris Nickel, that kind of thing. I mean, what has happened? Well, I had a look at the sort of numbers yesterday, and JP Morgan Russian's share price had fallen basically 23% on the day. But really, since all of this started to ramp up with the Russians putting troops on the borders, etc., it's lost about 51% since its peak at the end of October. Raven Property, that didn't do so badly. That fell 17.1% yesterday. And actually, it's not down as much as GRS. It sort of lost 45% since its peak in November, which is around about the same time. And I think perhaps the difference here is that, you know, with Raven Properties assets, these are sort of quite critical infrastructure for the new economy, effectively online retail, etc. So I think, you know, there's a sort of real difference. I think these are perhaps less vulnerable, but obviously time will tell. Bearing in your opportunities, that actually lost 23.4%. I mean, that almost says that really the value of the Russian assets are sort of nothing. So that is quite a big drop. And say it's lost 34% since its October peak. So people are asking me, are these good value? And I think it's fair to say that they're all cheaper than they were a couple of days ago. If you're prepared to ignore, you know, what's going on in Eastern Europe, you could make a case that perhaps they're good value. But I think you've got to be very, very wary of that. And sanctions are clearly coming. These are going to hurt exporters, although obviously these are much more limited because of the existing sanctions. And it's going to hurt those that are dependent on imports. As I said, what has happened previously is this has actually strengthened some domestic producers at the expense, really, of, you know, domestic consumers. But I think there are a number of other issues you need to consider. You know, how are Western governments going to respond to this? Are we going to see greater restrictions in terms of capital flows and the businesses you're allowed to do in Russia, etc., etc.? I mean, we could see restrictions. You could see asset freezes or asset grabs. And really, are they cheap enough to justify the additional risk? I mean, I personally don't think they are, even if you could ignore the moral implications, which really I don't think you can. I think that comes on to another thing, that in this sort of days, or these days of increasing emphasis on ESG issues, can you really sort of justify these sorts of investments? I think you've got to be sort of very, very careful around that. So for me, if you've got an investment, fine, I think you need to look at it. But would I suggest that anybody piles into these at this point? I think sort of some care is very much required. With that in mind, I'm just going to leave you with a quote from Carlos Hardenberg, manager of Mobius Investment Trust. They've had a good set of results out this morning, and I just pulled this out as I was covering those. As I say, there's a piece on our website, but this is what he had to say about Russia. Investors are well advised to steer clear of regions which are subject to significant political risks. This is especially the case when there are risks of sanctions, a sharp increase in the cost of capital, or worse, capital controls.